Many people who've been trading on prediction markets are about to get a unpleasant surprise at tax time. So if you are used to trading futures, you notice that you get very favorable treatment on the tax for those transactions when you win. It's called a 60/40 tax treatment under Section 1256. So if I trade a futures contract, even if I buy one today and sell it tomorrow, 60% of that will be taxed as long-term capital gains and 40% will be charged as short-term capital gains. So if you make a lot of money in futures, you get to keep a lot more of it than if you would trading stocks, because for stocks you have to actually hold it for a year for it to be considered long-term capital gains. But for futures contracts, 60% of that gain is automatically considered long-term capital gains, and the other 40% would be taxed at short-term capital gains. So under Section 1256, non-equity options get that 60/40 treatment. And you might think, well, these aren't stocks, so why wouldn't I get the same treatment for this that I would for trading oil or gold or natural gas? And that's because how they were structured when they started trading them. So unlike futures, swaps do not get the 60/40 favorable tax treatment. Section 1256 B2B excludes swaps from that 60/40 treatment. And why is that relevant? Futures aren't futures because they're traded on an exchange. Trading on an exchange is what makes them legal, not what makes them futures. So it's against the law for you to trade futures off an exchange on an OTC basis. So if it is a futures contract, it has to be on an exchange. And before the Dodd-Frank Act, there was many discussions about whether swaps were futures, and these were sort of angels on the head of a pin discussion. But eventually, swaps were brought under the jurisdiction of the CFTC. And although at the time all swaps were traded off an exchange, gradually they've been migrated to designated contract markets, DCMs, regulated by the CFTC. But just because you trade a contract on a DCM doesn't mean it's a futures contract, because swaps are also traded on DCMs. So if those contracts are non-equity options, are also swaps, then you would not get that 1256 favorable 60/40 treatment. And that is the case here because prediction markets generally structure the sports betting as binary options, and binary options fit within the definition of swaps. And it causes a problem because a client of mine was telling me about the 1099 that he got from Interactive Brokers. I'm not picking on them. I'm just telling you how it works. But the form he got, the 1099 MISC, reports the proceeds from prediction markets as other income. And if I bought a stock for $1,000 and I sold it for $2,000, normally when I get that report, it not only has the price that I sold it at, but the price I bought it at, which makes it easier to fill out my taxes. But because this is reported as other income, if you bought $5,000 worth of contracts and they settled for $6,000, they send you something that says that you got $6,000 as income, not $1,000. So you have to go through those contracts manually and add them up so you can deduct the $5,000 from the $6,000. So you're only paying tax on the gain, because when they send you that income statement, it's reporting all the money that you received as income, not deducting what you paid for at your cost basis. So you can figure it out by going through your brokerage statements, but it is a manual process, and it's kind of a pain. So a lot of people have Robinhood, and Robinhood uses Kalshi for their prediction markets, but Interactive Brokers has their own in-house prediction market called Forecast X, I believe. And I mentioned before that futures are required to be traded on an exchange, but trading them on an exchange is a requirement for them to be legal. It doesn't mean that they're futures. And if you try to argue very aggressively to the IRS that these are futures and therefore I should pay less tax on it, you would probably fail. Why? Because under case law, where The CFTC has sued people that were trading futures off exchanges. The courts have set out what are the elements of a futures contract. And they tend to have certain things in common. They have a underlying commodity, which they reference through some type of formula. There's futurity, meaning that it is settled at some point in the future. It's not just traded now and held in your account like a stock would be. There's initial margin, there is maintenance margin, there is settlement by offset. Those are all elements of a futures contract. And when you do binary options, let's say it's a $1 contract and the one side is 49 cents, the other side is 50 cents, and that adds up to 99 cents, and then the exchange keeps the penny. The way it would work is I put up 49 cents, the other side puts up 50 cents, and if I win, I get the whole 99 cents, and if the other guy wins, he gets the whole 99 cents. So there is no daily mark to market, and there is no margin going back and forth between the two parties, which are elements of futures trading. So because there is no margin, because there is no leverage, these would not be classified as futures, which would entitle you to that 60/40 favorable tax treatment under Internal Revenue Code 1256. And a hidden potential landmine that may come back to haunt people is under the so-called One Big Beautiful Act bill, because that bill gives the IRS more power to be aggressive in looking for what they call phantom income. So in looking at these contracts, and the IRS hasn't said anything about this yet, but if the IRS decides to classify this as gambling rather than derivatives, those losses could be capped at 90% of your winnings, which is far worse than the 60/40 split. And the current administration is pretty pro crypto and pro prediction markets. One of the members of Trump's family is a paid advisor to Kalshi, but the One Big Beautiful Act is a law and it says what it says. And the IRS in the future may decide to be more aggressive when it comes to taxing this income. And even if they don't say anything now, they could 3 years from now decide to look back and retroactively go after people who paid a certain amount of tax on this if they determine that this was gambling and that not derivatives, and that the losses are capped at 90% of the winnings. So that's another potential landmine for this. Anyway, that's my thoughts on that. My name's Peter. I have 26 years of legal experience, including 22 years at the CFTC. And if you'd like to work with me either on a consulting or legal basis, get in touch with me through the contact info in my bio. And since I'm a lawyer, I will give you the disclaimer that this is for educational and informational purposes only. It is not intended to be legal or tax advice, and doesn't create an attorney-client relationship between you and I, and is not intended to be relied on. If you have a specific legal or tax issue that you need to discuss it with your own tax advisor or legal counsel, and that is not me. So if you have any specific questions about this, just leave them in the comments below, and I'll try to address it.